spend in the areas where you're going to get an ROI. Where are you going to get an ROI? In the bar, in your guest room, in the lobby. That's what's going to be photographed out by your pool. Spend in those areas. Don't spend in the areas where like no one's giving you a TripAdvisor review based on the stone in the toilet while they're taking a, okay? So focus on the areas where you're going to generate huge ROI. When you're taking the hero shot in the lobby or the exterior of the hotel, the drive of the landscaping, focus the ROI there. You can make anything work and anything look good in an Excel spreadsheet. When it comes time to swinging a hammer, drawing a room layout, buying tile, that's when all hell breaks loose. All right. Hello, everyone. We are going to do a different show today. It's just going to be me. I'm going to be riffing, talking about the mistakes that I've seen, other people make for investments in hospitality. We're going to talk specifically about hospitality real estate and the mistakes I've seen investing in hospitality real estate. There's like a million mistakes that you can make, owning it, operating it through the life of the investment. But I want to focus this conversation on the mistakes made really at the beginning, the investment. And a lot of people in real estate will tell you that all the money's made in the buy. I think hotels are a little bit different because they are operating businesses and there's a big value add component if you are investing in an existing hotel that maybe you want to reposition, reimagine, or even in a ground up hotel. Building the real estate is just one part of the story. The second part of the story is giving that building life, turning it into a reality, turning it into your dream, and making it an operating business. That's why hotels are so hard and it's so easy to make mistakes. So I could have hours and hours of content about all the mistakes you could make, but we're just going to focus on the initial part, the investment side. And what I've learned is there is no substitute for experience. And I've been in the industry a long time. I've had the good fortune of seeing a lot of my friends in the industry have big successes, big failures, problems, opportunities, how they've solved those issues. And it's really helped my own career. So one thing before we start that I'd recommend, if you're getting into a new industry, if you're getting into hospitality, you really need to find a network of people already in hospitality so that you can learn from them, because there's no substitute for experience. And even if you have experience, I've been doing this basically my whole life, but professionally investing since I graduated law school in 2011. I was even working in some of my family's hotels before that. There is just no substitute, no way to make up all that experience. It just takes so much time for you to see things, for things to play out, for cycles to occur, for problems to happen. And people that have had a ton of success over a short amount of time really haven't had all the success, because that cake is not baked yet. You have to live and you have to survive multiple cycles in order to really say that, hey, I've made it in this certain industry. And if you don't have experience, the best way to get experience or to get the benefit from experience is really to meet and speak with others that have had the experience. So build your network, talk to people. Not everyone is an enemy. Not everyone is a competitor. I really think of the world as a zero-sum game. I have an abundance mindset. I'd rather see everyone win. And hopefully people in my network feel the same way. Hopefully you feel the same way. That's why we're here. That's why we're learning from each other. And you should really take advantage of everything you have, whether it's podcasts, YouTube, in real life interactions, Twitter, LinkedIn, anything. Go out and meet people and go out and test your business ideas, test your business plan against those people. Obviously, you got to be somewhat protective over confidential information and maybe your special sauce, but you should definitely workshop these ideas with people in your network if you build up a network of people that have experience in the thing that you are doing. And what we are going to talk about today is the mistakes made in hospitality investing. So I kind of broke it down into 4 categories. I first want to start with location, location, location. This is like the basics of real estate. It applies, I think, more so than potentially a lot of other classes of real estate for hospitality, because if you pick the wrong location for your hotel, it could completely bury the hotel and there might be no chance for your hotel to survive. Consequently, if you pick an amazing location, your hotel could blow out its competition, can really distinguish itself from the competitors, and can be an amazing asset, an amazing investment. When you talk about location, I think you got to think about the market first, and then we'll zoom in and talk about the street, the neighborhood, the area. But let's talk about the market. So we primarily invest in markets where there's high barrier to entry. There are businesses moving to that market. There are people that want to go to that market. They have a big leisure demand base. For us, that's very important. I think leisure demand is the most sticky, less cyclical. Businesses are always going to be very cyclical, going with the economy. And group business, convention business would really fall into that business segment. But if you have a very strong leisure base with a little bit of diversity of demand from other segments sprinkled on top, that is the recipe for a great demand setup. But your property has to be incredibly well located within that market. The other thing we really look at is governmental red tape or other headwinds. So we are really not investing in markets today where there's a massive amount of risk for things that we can't control, such as maybe it's union risk, maybe it's development risk, maybe it's tax risk, maybe it's government risk. All of these things that we don't think we control, where there are governmental bodies or other people that may have a say in your business, we want to kind of try and stay away from those markets unless the business opportunity is so far outweighed by those risks. We're going to stay away. So there's certain markets that I just don't even look at. And that's really changed since COVID. There are markets that I used to think were great markets pre-COVID. Post-COVID, a lot of things have happened in the world, political shifts, market shifts, mentality shifts. And I really want to invest where the momentum is going and where business is free, places where people want to be. I think weather is really important, particularly for hospitality. And you want to be in a market where there's very robust demand and it's somewhat difficult to add a lot of new supply. Now let's talk about like the specific location within the market, the street, the neighborhood, the area, the amenity attraction location. So what I mean by that is, like, if you're in a beach kind of market, are you on the water? Are you on the sand? Are you across the street? Are you downtown? If you're in a resort kind of ski market, are you on the mountain? Are you in town? Are you outside of town? Where are you? All those locations could have positives and negatives, but where you specifically are can have a major impact on the success of the hotel. So the simplest way to think about this is, what is the proximity to demand generators? If you are generating your own demand because you're like Blackberry Farm, then it doesn't really matter where you are as long as the landscape is beautiful and the area is conducive to the experience you want to create, because you're going to bring the demand in. But if you're building a convention center hotel and it's nowhere near the convention center, then obviously that's a problem. If you're building a convention center hotel next to the convention center or attached through a walkway, that sounds like a pretty good deal. If you're building a resort property in a tropical or Florida-like climate, you're going to kill it if you're on the beach and you're adjacent to the water. You're probably not going to do as well if you are downtown or if you're off the beach, unless you are creating your own induced demand. Sense of place is so important. And you hear a lot about placemaking. I mean, Austin has such great placemaking. If you can create a sense of place around your hotel because of the location, because of what it looks like, because of the things around it, then that could be a huge advantage to you in the market and the success of your hotel. So perhaps you can kind of create something that was overlooked, that might have not been there. That is definitely a big opportunity for a lot of people. You definitely want to invest in a place with minimal supply. If you're investing in a hotel market and there's a ton of new supply coming in, it's going to be very challenging. You also have to think maybe it's not new supply, but maybe all the hotels are getting renovated and you don't think you need to renovate your hotel for another 3 or 5 years. You're going to be behind the 8 ball because now you have all these new hotels that are competing with you with brand new splashy furniture, fresh paint, the whole deal, and it's going to be challenging. So it's not just new hotels that are being built. It is hotels are being renovated, hotels are being enhanced, upgraded. Take a market like Fort Lauderdale. Fort Lauderdale had a ton of new hotel supply come in from probably 2019 to 2022, 2023. And in some submarkets in Fort Lauderdale, RevPAR, revenue per available room, despite Florida being like the greatest place to invest, have had flat RevPAR over that period. Why? Well, ADR is through the roof. ADR might have grown 30, 40%, 50% in some cases, but occupancy is still below 2019 levels. Why is that? Isn't Florida a popular place to go? Yes. Are people going back to cruising? Yes. Are people coming to the beaches? Yes. Well, aren't people going to Mexico and the Caribbean now? Yeah. So that would kind of dip it a little bit. But what is the biggest reason why occupancy is soft? New supply. More hotels came in. The demand wasn't as robust as maybe it was during COVID, or all the supply hasn't absorbed this new demand. That is a concern. South Beach, another market. The dollar is very high. South Americans and Europeans and Asians are down. They're not as high as they once were. There's a ton of supply in Miami Beach. That is impacting performance. Now you combine that with rising expenses, that could be a recipe for a disaster. So it's really important to understand the supply picture, because supply could come in, might take a few years to get absorbed. By that time, you miss a cycle, your debt is expiring, your whole business plan could be completely blown out. The other thing that's really important on the location side is knowing your customer. What is your customer here for? What is the vibe? What is the energy you are trying to create in your hotel? If you are a fully business hotel, then you should cater that business customer adjacent to all the business demand. If you are going to be the Aloft Hotel in Cupertino that's going to suck all the demand from Apple, then you should be like right next to the Apple headquarters. If you are building a leisure hotel, a resort hotel, you don't need to be next to the Cupertino Apple headquarters. You could be in a different market. So knowing who your customer is, knowing who you want to sell to and who is going to come visit you is really important. Again, going back to Blackberry Farm, they built this thing in a pretty remote area. They had to make sure people were willing to travel to them. There's decent airlift. That's another thing. You gotta understand how people are getting to you. Are you a drive-to market? Are you a fly-to market? Miami's a fly-to market. Places on the Panhandle in Florida are drive-to markets because you've got everyone from like Atlanta, North Carolina, South Carolina driving down. Different setup. Really, really, really understand your location and how people are going to get to you and who your customer is. A great example of a market that just ripped so hard, so much better than Fort Lauderdale. I think we missed the market. It was such a good opportunity. I turned down so many deals in West Palm Beach, but an amazing hotel there, The Ben. You've heard it in the news. They're trying to get $1 million a key. I don't think they're going to get $1 million a key. Phenomenal hotel. I hope those guys crush it. Wheelock bought it. I think they will crush it. It's going to be a great deal for them. Maybe they get $1 million. Maybe they get $950. Who knows what they get? But it's very difficult to build a hotel in West Palm Beach right now. Okay. There's a lot of office demand. Steve Ross is building all this office, building all this multi, building all this retail. It's very expensive to build a hotel. They have locked in an amazing A+ site overlooking the water. Contrast that with maybe another hotel in West Palm that has slightly less views. They might not be able to generate the ADR that the Ben is generating. The Ben has a rooftop pool that's not really the most amazing rooftop pool ever, but it crushes it because they manage it well, they have it set up well, they know how to sell, but it has a whole view of Palm Beach Island and the marina, the yachts, the water, the whole thing. It's a vibe. That location is amazing. You take that hotel, you move it 3 blocks west, it's not going to do those numbers. So when you're thinking about buying a site, maybe it's worth paying an extra $3 million to have that water view than to be 3 blocks west and say, well, you'll capture enough of the demand, because sometimes you won't. And I've seen that with certain deals in our portfolio. I've seen it in certain deals in my friends' portfolios and other people out there. It could be a challenge. The other thing that you have to think about location is if you are buying a hotel, renovating a hotel, building a hotel, and let's just say you're next to like Google's headquarters, okay? And your business plan assumes you striking some deal with Google to use your new hotel as like partially a dorm for all their employees that are coming in, their like special hotel. And then as you're building it, you don't have a locked in deal with Google. They decide to do something else. They decide to build their own hotel. Like your whole business plan just got blown up. So as you're thinking about location, it's important to really have all the elements of the location locked up before you start taking a lot of risk. What makes for a bad location? I think view, lack of view, sense of place, like lack of nature. The area just looks sketchy if it's not really developed. Obviously, I think that could be a challenge for a lot of hotels, regardless of the market segment you're trying to target, because you're always trying to generate more revenue. Okay. So even if you're a Hampton Inn, you don't want to be in a shitty location. You want to be in the best location for Hampton Inn. We own the Courtyard Hotel we invested in Chelsea and in New York. And it's an amazing location, amazing hotel, mid-block. That thing crushes it because of the location. Another thing that's important is challenging access. This guy was once trying to pitch me this deal in Florida, and it was like kind of on the water, kind of not on the water, very tight site, very hard to build on the site. But the other thing is there was a 2-lane road, and in between that road, there was like a walled median. So you couldn't turn into the hotel without driving like 2 blocks down the street and making a U-turn. That's annoying. People might not stay in your hotel because the access is messed up and it's not convenient to get there. The other mistake I've seen people make is assuming just because a hotel brand has approved that location for a hotel that it's going to be successful. The hotel brands are smart. They have a lot of data, but they are not really in like the hotel business. They are in the branding and franchising business and the management business. Okay. So they are not in the business of investing in real estate anymore. You look at Hilton and Marriott, that's not what their business is. So just because they approved a site for you, or you are buying a site that is approved to be a tribute hotel or an autograph hotel, they're smart. They're going to pick a good location that they think makes sense. It doesn't mean it's going to make business sense for the deal. It might make sense for them in their portfolio. It doesn't mean you're going to be successful. So don't be swooped in and feeling like, oh, they approve this site for that. I mean, they approve a lot of sites. Okay. Like they know what they're doing. The higher brands are obviously more exclusive. Those sites are going to be more dialed in, but the other ones, they're going to be flexible, and you might not be successful in the site that they lined up. And they could have just picked that site because they had a mandate. They had to get a flag here, had to do whatever it takes to get a flag in this specific market, even if it's the worst site in the market. So don't be using that as like your guidepost to determine whether the deal is going to be good or not. The other thing that's important is not appreciating a shift in demand. If you're investing in a market where they're having trouble with the convention center, or the convention center is slow, or it's old and it's busted up, and you think that it's somehow just going to change and that people aren't going to want to have these conventions in other big, bright and shiny cities, then that seems to be a huge miscalculation on your part. And you really need to understand whether you are with the momentum of demand or against the momentum of demand. And some people are making investments because things seem cheap, but really demand is getting sucked out of that area and it may never return. Okay. So very, very important. All right. We talked about location. Now let's go into like broken business plan. This is why it's very, very important to have a network of close, trusted people, mentors, friends, colleagues in the hospitality business so that you can workshop your business plan and idea. And if you are not really from the hospitality business, maybe you've dabbled in it a little bit, and you come up with this whole plan, you think it's amazing, and you base a whole business around it and a whole investment thesis around it, and you start trying to make investments and raising capital, but you don't like, what is it called when like you red team something? Like, the FBI comes in, they want a red team. What is the devil's advocate? You don't play that game with your trusted friends and colleagues. That's a huge mistake. These people could have saved you millions and millions of dollars if you just would have listened. They could have also tweaked your business plan and make it better. So I think it's really important to discuss the business plan out loud and not just with yourself or with the people that work for you, because that's like an echo chamber. If you have this like business plan for a programmatic acquisition strategy, all the people in your company, especially if they're newly hired, may kind of agree with you because they're afraid to disagree with the boss. I mean, I have a culture in my company where I encourage disagreement and I want people to express different ideas, but that might not be the case in your world, in your business. So go out and seek feedback from other people in the business that have the expertise, whether you have the expertise or not, because someone may have done something similar. Someone may have seen someone do something similar. Someone may have heard this from someone else and can share an experience that would be very, very valuable to you and the success. Another problem that I see with a lot of business plans is especially in hospitality, like hospitality is the opposite of the tech business. The tech business moves so quick. Everyone's talking about AI and chips. Hospitality, people are still talking about like keyless entry. It was like 10 years ago. Okay. And how can we improve revenue management and automate it and all this nonsense? Hospitality is slow to change. But from an investment standpoint, investors in hospitality are also slow to change. A lot of people are still investing in business plans that were a good idea like 20 years ago, but I don't think they're a good idea today. A lot of things have changed, particularly in travel in the past 20 years. Massive shifts have happened in travel in the past 4 or 5 years. Look at outdoor experiential travel. All the hotel brands are buying up little concepts like AutoCamp and making a big name for themselves in that space. And it was never even heard of a few years ago. Huge focus on resort and experiential now. Some of these hotels, honestly, may never come back. They could be obsolete. They're like a big oil tanker. I don't know that, a value add business plan of 1,000-room Sheraton outside an airport in Chicago is really a winning strategy, because maybe people don't want to go to that kind of hotel anymore. Maybe it's obsolete. Maybe things have shifted and they're never coming back. Hotels are very different than other real estate asset classes. It's hard to say that about multifamily, but in hotels, it's very, very true. So to just assume that you can get back to a historical number without recognizing a shift in mindset, demand, market, strategy, experience, whatever it is really, really, really a recipe for disaster. And I've seen people make mistakes, 100%. I was pitched a business plan today, and I honestly have the opposite strategy. And this person was not in the hotel business. They owned like one hotel, and they pitched this business plan, and I think there's going to be a lot of challenges. And it's not really new, not really inventive, but these people thought it was like the greatest thing since sliced bread. And we got off the call and we're like, oof, that's going to be a tough one. That is going to be tough. But had they had kind of workshopped this with other people in the network, they might have gotten some free advice. Now, you could be right. You could be the contrarian and make a ton of money. And maybe they will make a ton of money being the contrarian, but you should still know the counter argument. You should still know what the challenges are, and then make a decision internally whether you want to proceed or not. Another big mistake people make in investing is market cyclicality. You can never time the bottom. You can never time the top. But generally, I think it's very true in hotels. You know where you are. You know if you're closer to the top or closer to the bottom. You know if you were just kind of went through the bottom and maybe you're on an upcycle. You know if you're at the top, something's about to happen, shoe's about to drop. You can kind of feel it. I remember going to conferences from probably 2016 to 2019, and every line, every data analyst, every expert was always like, we're in the 12th inning, we're in the 13th inning, we're in the 11th inning. Like, how many more innings are going to get? They knew you were at the top of the cycle, and then COVID happened and boom. Now, for certainly some resort hotels, it was like a major boom to their business. But the majority of the hotels across the country, traditional Hilton's, Marriott's of the world, got smoked during COVID. And that was like top cycle, peak cycle. Now, COVID happened and asset prices bubbled and there was a big ramp there. But you could tell that that was like this ZERP period, this hype period, and you could sense it. So you know kind of if you're at the top, kind of if you're at the bottom. You really have to think about that in the context of your investment. So if you feel like you're at the top and you're buying something, well, you've got to be prepared to weather it through a down cycle. And a lot of people in the most recent cycle weren't able to do that because interest rates tripled. They didn't have enough reserves. Their expenses went up. Their cash flow got decimated. And some of them had to give the keys back. Some of them needed to take preferred equity from us. Some of them had to put in a ton of capital themselves. Not knowing where you are in the cycle could really mess things up. Consequently, right now, I think we're at the new part of a real estate cycle. And the new early part of a real estate cycle is always the best opportunity to make a lot of money because you have the entire upcycle. I don't know if like today's the bottom or a year ago was the bottom, but given the activity, given what's happening, definitely feels like the bottom. Could something else happen? Yes. Could you drop further? Yes. But we're definitely not at the top. Hotel transactions are well below peak levels in both deal volume and dollar size. So, interest rates are high. Banks are locked up. Feels like we're at the bottom. Feels like we're close to the bottom. We're somewhere in that area. So now is probably a good time to invest because you're going to be able to ride up an upcycle, but still you have to be prepared for a potential downswing, a downturn, a little bump, because maybe you're close to the bottom, but you're not there yet, or maybe you're past it. You don't know. One, like the greatest resort in the Caribbean, literally the greatest resort in the Caribbean. I don't think anyone will ever build a resort like this, was interrupted by a few things. They had cost overruns, they had challenges because it's really hard to build in the Caribbean, but they also missed the market cycle. And when you're doing a development deal, it's so easy to screw up the cyclicality because construction costs have been extended recently. A lot of things can happen during the development cycle and you could just miss the window. So this resort in the Caribbean missed the window. They basically opened in the middle of like the great financial crisis and debt was challenging. Travel was down, really tough time. They ended up losing the hotel. A friend of mine bought it, turned it into, rebranded it, brought in a new company, and the hotel is phenomenal. And then he sold it and made a ton of money. And that was really market cycle driven, combined with probably some cost overruns that probably even extended the construction schedule and maybe even pushed you further into that cycle risk. Even in our own deal, we were developing a hotel on the West Coast. And because the California bureaucracy and the craziness, I probably won't do another development there again, side note, but it took 3 years to get it done. And that was like normal. Like we moved, we cranked. But by that time, construction costs had risen to a point where the project was not really feasible. But then we also missed the cycle. I mean, like COVID happened, like it just blew out. Now, one might argue that like that's a great time to build a hotel because you're going to be opening into a new part of a real estate cycle. But still, cycles could screw you up. So it's important to go into an investment, go into a deal, knowing where you are in a cycle. All right, we are going to end with cost overruns. This, like for hotels, is the most common way people mess up an investment because they underestimate the cost it will need to create what they want to build. Let's break this down to two different things. You have renovations or ground up. Let's start with renovations because a lot of people are doing renovations. I think it's a great time to invest in renovating an asset, a boutique hotel, lifestyle hotel. You kind of buy an old crappy motel, convert it into a cool hotel. Could be cool, but we're looking at a pref deal right now. I think these guys got too far out of their skis. They invested too much money. Maybe not their fault. Maybe just the cost of renovation. And it's going to be an opportunity for us on the pref equity side. How do you screw up a renovation? Well, you can make anything work and anything look good in an Excel spreadsheet. When it comes time to swinging a hammer, drawing a room layout, buying tile, that's when all hell breaks loose. You can make anything look good, make anything say what you want to say in an Excel sheet. And I actually learned something from Blackstone recently, and I think their approach has always been buy it, fix it, sell it. But I think another approach they have is to kind of, when they're getting ready to sell it, they don't really necessarily renovate the asset again or make it look perfect, because any new buyer will always convince themselves that it's likely going to be cheaper to renovate it than it actually will. So if you're an owner and you have a PIP coming up, or you have kind of this capital expenditure project that you need to do, and yeah, sure, you could argue it'll enhance the value, but maybe it's just kind of, preventative maintenance-y kind of stuff, and it's not going to be that great of an ROI. It's probably better to push that off onto the seller. Why? Because the seller, or the buyer, is likely going to convince themselves that it's going to be cheaper for them to do it than it's actually going to cost you to do it. And that's what I learned from Blackstone. We were looking at a hotel they were selling. I'm trying to think of myself, I'm like, why have they not renovated this thing and put it in like perfect condition? It was like, I don't know, 65, 70% condition maybe. And I think the reason was because they knew that the cost would be pretty high, and that a buyer, especially as the bidding got tight, would convince themselves, I'm entrepreneurial, we can cut this, we could delay this, we could do this way. And you type some stuff into Excel and the numbers come down. Common way to make mistakes on the renovation side is on the underwriting. Another common way to make mistakes is underestimating what's behind the walls in an old building. And we bought a building built in the 70s, big hotel. It's now one of the nicest hotels of this brand in the country. Came out beautiful. We spent way more money than we thought. Even if we reserved for things that we knew were going to go wrong or that we knew had to be addressed, it was like double that. Old buildings are expensive. They are really expensive. The pipes break, there's leaks, the air conditioning's bad, all the systems are bad, and you end up having to replace all this crap. So if you're buying an old building and it hasn't really been fully gut renovated, it's going to cost a lot of money. And frankly, I'm going to really think hard before we buy a building, in the 70s, 80s, maybe even 90s timeframe going forward. There's a lot of work. And every year, as the years go by, you maybe push that age of the building back from where you're willing to invest. Maybe you're not willing to invest in a 30-year-old building right now. I'd really have to think about it, because there's a lot of skeletons in the walls, a lot of cover-ups, a lot of paint jobs. And when you have a hotel, everything gets multiplied by the amount of rooms you have. So you got one leaky pipe, you multiply it by 300 rooms, you got 300 leaky pipes. It's a lot. It's a lot to deal with. So, the other thing from buildings from that time frame that you got to think about is asbestos, suspicious material. You also got in like Florida, you got mold. You got to get rid of all that stuff. You got mold in the ducts and you got to suck it all out. There's like a big investor that bought this big oil tanker hotel recently in Miami. And I'm like, they're going to spend all this money renovating it. They're going to do all this stuff on the inside. On the outside, it's still going to look like a dumpy old building. And, when you have pretty weak architecture and a lack of sense of place, it's tough to overcome that. So old buildings are hard. Another, I think, mistake people make on renovations is like misunderstanding what the customer needs and wants. And what we've seen in our own projects is we might, when we're underwriting a deal, when we're buying a deal, we might think we are going to do this. But then when we own the hotel for a year, we actually realize like, oh no, that's kind of a waste. We're actually going to do this with the money. So what I'd recommend is to get the obvious stuff done very early, right when you buy the hotel. Don't wait. But then some of the stuff that's like kind of like interior business plan execution style, like maybe you wait a little bit. Maybe you wait a year and you see how the hotel is used. You see how the guests use the hotel. Like, for example, we bought a hotel recently. We're gonna like, redo the bar and make it all cool and like more of a cafe style, grab and grow and spend all this money in the bar. And then like the bar demand has been somewhat weak. And you could say, well, it's because you haven't renovated it. No, it's because in this hotel, people are going to the restaurants or doing this. They don't really need the bar, but they needed a bar at the pool. So what we did is we pivoted and we focused our energy on enhancing the pool and building out a little kind of bar at the pool. That was our focus there. We wouldn't know this stuff till we lived in the hotel for a little bit. But the obvious stuff you take care of early. Some of the stuff that's on the margins, it's good to wait a year and see how the business plays out. Let's transition to ground up. Like the biggest mistake people make in building a ground up hotel is locking in a GMP. Some people call it guaranteed minimum price. The official term is guaranteed maximum price contract with a GC, and doing that before you have 100% plans and specs. And I'm talking about interior drawings too, and all of your consultant drawings. All that stuff has to be done, because if it's not done, if it's 80%, it's 50%, 70% not done, then your guaranteed max price contract really becomes a guaranteed minimum price contract, because they're not pricing anything. It's not done. It's going to change. You got a big bunch of allowances. That's where I think a lot of people go wrong. So it's better to invest the time, money, take the risk early, finish those plans, value engineer with the GC on finished plans, have them tweak specifically so they can write into the contract what assumptions they're making, and do the hotel construction that way, as opposed to designing it as you go. Delays. Ooh, man, construction delays, just timing delays, permit delays, all that stuff. And then the impact and its relation to cycles really, really can screw up ground up developments. I mean, we've seen it in our own developments. We've seen it in other people's developments. Sometimes stuff is out of your control, and that's the risk of development. That's why you're shooting for a very, very high return, very high multiple of money to compensate you for the risk. That's why you got to be prepared to potentially own this thing for a very, very long time. It's hard. It's not like merchant building and multifamily building. Hotels are different. Another mistake that we've made actually is overspending in non-ROI areas. So we were working on a hotel, and it's gonna be like a 5-star hotel. We had some cost issues, and the designer was an amazing designer, but she just obviously wants to make everything amazing. And certain things don't need to be amazing, because when you have 300 guest rooms or 150 guest rooms, you're gonna have to have 150 bathrooms with this special handmade, carved, painted tile, and it's gonna add up. So in that deal, we over-designed the bathrooms. The bathrooms had like marble and stone and all these intricate details all over the place. They were too over-designed. They drove the cost. And I was actually staying at an amazing hotel. I think one of the best hotels in the country is the Four Seasons Hotel in Philadelphia. If you haven't been, check it out. Amazing hotel where you like, the lobby is on the 60th floor of the Comcast Tower. I grew up in Philadelphia. You have a whole view of the city. It's nothing like anything that was ever in Philadelphia, but it's world-class hotel. And the rooms are really great there. Amazing views, really great layout, great space, great ceiling heights. But the bathrooms are actually pretty simple. They're beautiful, but they don't have like stone all over the walls. They have paint. In the shower, there's stone, but not all the other walls around the toilet, around the sink. They're kind of paint. And I went to the Four Seasons Philadelphia, and I was like, damn, we really missed it, because look at this. This is a Four Seasons. This is the best luxury hotel company, like one of them in the world, right? And they didn't over design. They've learned because they knew if they wanted to build more hotels, it's got to be financially feasible, right? So you can't overspend everywhere. Spend in the areas where you're going to get an ROI. Where are you going to get an ROI? In the bar, in your guest room, in the lobby. That's what's going to be photographed out by your pool. Spend in those areas. Don't spend in the areas where like no one's giving you a TripAdvisor review based on the stone in the toilet while they're taking a poo. Okay. So focus on the areas where you're going to generate huge ROI. When you're taking the hero shot in the lobby or of the exterior of the hotel, the drive of the landscaping, focus the ROI there. Does your building need to be clad in stone and all this intricate, crazy details on the outside? Maybe, but maybe not. Maybe there's other ways to do things, and you could move those dollars into areas where you can actually generate income, like to a beautiful courtyard where you can sell for weddings and events, as opposed to just a kind of crappy landscaped thing with no vibe, no setting. Focus on spending dollars where you're going to get a return on investment. So that was like a quick primer on some of the biggest mistakes I've seen when people are making hospitality investments. Again, from the start, there's like so many mistakes you can make as you own the hotel, as you build it, as you design it. But I wanted to focus on the investment side and all the mistakes that I've seen, the ones that I think are the most important, the ones that I think you're most likely going to come into contact with. Those are the ones I touched. I hope you found it valuable. Thanks for listening to the podcast. I really appreciate it. Don't forget to give us a review, subscribe on YouTube, subscribe on Spotify, subscribe on Apple Podcast, share it with your friends. I spent a lot of time and effort putting these together, getting the guest list, and I would really love as many people to see it as possible and help as many people as I can, inspire as many people as I can, and grow and watch everyone succeed. So here's to you. Thanks for watching the show. I appreciate you. Have a great day.